Okay, here we are. A very nice clinical trading day. We went through earlier, but a lot of textbook in the afternoon, particularly on the what we trade, which I'll talk about what I trade normally first. Mainly today, all I traded with the S&P and a little bit of oil and Apple. Apple, I didn't put on trades really till the last 30 minutes or so, watching how it's set up. We did one trade earlier in the morning, often where we take advantage of numbers. We saw let me just go through what we did very quickly, and then I'll pass you on to the Sheik and Alex. So we look at the daily here. Remember, we've been talking about that all week, the Tenkan on the daily chart. It got up there perfectly today. Even better was what we saw in Chico's. It had power. We sold it. Nishi got out a little bit too early because of what we saw here on the market profile at 80. Took a few handle loss and then put the short back on, and we all know what happened there. Daily kept you short most of the day. It actually broke through Cajun and 50. We move on to 60 minutes. And this is what was where the discipline came in nicely. So that's that short. On the hourly, you can see here, if you weren't looking at market profile, you actually would have just stayed short, which when I pass you on to Sheik, he just stayed short purely through Russell, I believe, but definitely Nasdaq. And he was saying, what are you buying? Don't buy that. He was right, but I'm very disciplined on that. This is where we lost about 7. We put it back on. We did a few trades here on the double bottom. We made a little bit. We did one safety short, I like to call them, if it can break down. It didn't. We bought around -2/8 and we got all this, which we'll talk about later why. And if we go to 5 minutes, you can see specifically what we did, right? Now, here's a thing of caution. On the hourly, I stayed longer short, and then when this long happened here, we stayed longer. See, I actually got out of here and had to buy basically here. So it turned out I didn't really give much back here, but I gave that little bit back by having to rebuy. But technically, you can see all that perfectly. We watched the vol change, and I'll go through that after the other two guys talk about their futures trades on Apple. But there was a nice, good setup on Apple today. Mahdavi, if you want to walk us through, because you nailed that Nasdaq.
Well, today, the only move was all the money was made in the morning when we had that sell-off. The Nasdaq was probably beginning the day up. We were up 120, and we just sold straight down from there. Going into the last half an hour, we knew we thought there would be some window dressing, and they didn't want to put the market down 400. So I basically cleared out all my shorts and went long, looking for the window dressing to the end of the close. And that's what I did. And when the market closed, I sold a little bit off and see the market sells down a little bit. But most of the money was already made this morning. And what they did with these people, they kept on getting in long and short. They kept on getting stopped out because they're trying to pick bottoms. And toward the last half an hour, a lot of those guys gave up, and they probably got caught short on that last run-up. And this tells me with the window dressing, this is going to be a continuation into next week, I believe. So I think this is the start of things to come.
Yeah, thanks. Yeah, it could well be. We may get and it's a good point. They tend to, and we talked about this before, they tend to gap it up, or at least have a run at the highs, which we saw today. And then, so they get everyone in who's so used to bottom picking, and it gets up there, and that's all they know how to do. Then they just let loose, right? So in other words, remember, if you're buying something, you're selling it to someone, and vice versa, right? And that's what we saw beautifully today. And we saw the panic across the board. I mean, I'm looking at stocks that they're 70-80% down, right? I mean, a lot of these are rubbish stocks that we're a little bit old school, so they were in our face when they were ripping up. We're not ashamed to admit that, but I don't know how many times I go, this is different. Oh, you don't know the world, blah, blah, blah. So that also gave us hope when we saw the technical buy and then what the sheik was seeing down there. It worked very well to get onto that buy train at the end. Alex? What
Yeah,
about you?
so today was a day where fear dominated the tape after that initial reversal lower, and when it really started to seem like this was going to be a replay of similar days, we start strong and then just sort of sell throughout the rest of the day. I got it in my head to take off my longs and to get short of some Russell, some S&P, and to get long of some gold and some volatility mini contracts. Because basically my approach to today was, look, we've got rates going down, but they're going down because of fear. So other competing long duration assets like Nasdaq are not going to benefit. But fear-based long duration asset like gold could do well in an environment like today. So, I was buying gold on that, and I sold gold into the afternoon when its upside started to stall. I sold my VIX, within about a last half hour of the close because I really don't know what institutions are going to do. And I had a kind of a similar view as Mahdavi, as I didn't think they were going to run it all the way down into the close. Just felt like it wasn't necessarily the most likely outcome. So I closed out of that. I also covered my shorts. And really, the reason that I put on that trade the way I did is I didn't know necessarily which leg of that trade was going to produce the best return, but I did feel confident that each leg of that trade could have a good return where the risk was lower than the reward. So I set pretty tight stops on those. I did not get stopped out on any of them. My price targets were probably a little more aggressive, but I also use time and I limit myself. So if I see a trade that's not moving the way I want to in a certain amount of time, I'll typically get out of that trade as well. And that's one of the reasons I got out of gold, is it just kind of stopped moving higher. And I felt like I could start to look at maybe raising some capital to look at deploying it elsewhere. And then, on my individual stock trades, I didn't really do much today. I was mostly driven by trading futures, because on a tape like this, it can be really hard. Even if you're in the best sort of, short squeeze play or other kind of momentum play, the bottom can fall out very quickly. So I didn't do any of that kind of momentum stuff that I typically do during the day. And I usually am more likely to do that on a stronger tape.
Yeah, that's a good point. Like I said earlier, I basically didn't trade any stocks. Did I trade any other than Apple? I don't think I did. It was a good day not to get caught, as you said. And sometimes the trades you don't do are the best trades you do. So we just concentrated between us in the group here pretty much on futures. Did some oil and natty gas, of course, which we don't talk about much, this because I know most stock market people don't do it. But basically on a day like today, it was a risk-off day. So wholesale selling across the board. I know Alex mentioned, I didn't see gold, but he's mentioned it got whacked. Oil got whacked.
I'm sorry, gold was up. Gold was up on the fear bid.
Oh, I was on the fear bid. Sorry, I misheard that. So often
You're good.
that will go with the commodity, but usually that trades as a currency, inverse to currencies. Been a while since I've traded that, so I'm happy to be corrected. Natural gas is a lot to do with weather and production. And I am flat now. I'm not over the weekend. I won't have a position in that because that's going to be a lot to do on the weather tape. Oil, very much a fear factor. It's been a violent week for that this week. A violent week with OPEC, US government noise. It's just a lot of noise. And then we had, of course, a friend of ours, Chad, mentioned, I think, and he said it, oil doesn't like lockdowns, and that's pretty well that simple. The one stock trade I wanted to mention was what I noticed was on Apple, it had a move and the options were lagging, both calls and puts. The vol was coming off all of a sudden very fast as it was going off. So that was a classic vol seller selling it into the weekend, trying to capture that vol over a weekend. And the stock was ripping. And how I noticed is I bought the strip and I noticed the 70s were coming off way too much than what they should. I sat and then added to that across the curve, and lo and behold, Apple just exploded. So that's telling us some of that vol selling would have been they were going to buy the underlying, or they were caught on it. because it takes a long time for a leopard to change its spots, and they never really do, right? And that's what we're seeing: dip buying, getting destroyed, the same vol sellers. It's the same habits, and that's why we're getting these dramatic moves. And they are big moves. And we can blame Powell, we can blame Biden, we can blame whoever we want. But most of these are fairly predictable because everyone's getting the same way, you know. I mean, that's what I'm saying. But so that's really all from me. I can't talk a lot about individual stocks because I can't say I really looked at them. So we just looked en masse. And the other thing that gave us some comfort in buying when we did was the VIX, the vol was getting paid. And what I saw in Apple, the Sheik saw the same thing on VIX because he trades that. So it was across the board, that going on. And then once you saw that bid came in, you basically knew they were wrong, you know, as far as that goes. The way because then you could see the price action, they turned around and covered that. So yeah, interesting. So that tells us they were probably trying to get short, and there was a bear trap there, and then they just, you know, kind of tore the face off the market for whatever reason. Obviously, a lot of it's window dressing. Anything else, lads?
Yeah,
No.
I got a little bit more I want to weigh in on just because I think one of the things that we typically see during drawdowns is rotations are more likely to happen. And so, you know, within the last week plus of these drawdowns, we've seen a change in which factors and which sectors are preferred. And so, you know, even though a lot of things are being sold down, there are little pockets of strength that are very, very important to pay attention to. So for today, for example, we saw low volatility, large caps. That was the factor that had a bid. Every other factor was sold off. And the weakest factor was Russell 2000 growth. So low volatility, large caps in play, a safe haven, and Russell 2000 growth exiting portfolios in mass. And that's a high risk area. And then in terms of sectors, I like to track the sectors on a day by day, week by week, month by month basis to kind of see where flows are going. Today, the strongest sectors, probably somewhat unsurprising, silver miners, consumer staples, gold miners, utilities, healthcare. Those were really the sectors that had a bid. It makes a lot of sense if you consider the backdrop. And if you look at, you know, money managers who are probably saying, okay, I've got money to add and allocate into the market from selling or from getting new funds. Where am I going to put it on a day like today? I don't think you're going to go out there and boldly take risk in these sort of rate sensitive stocks. And certainly that's what the flow spoke to, as a much more conservative asset allocation preference. We also saw a very strong bid in the 30-year bond. I think that's really important to talk about because, you know, this has been, you know, the subject of a lot of back and forth from economists and from analysts. You know, everyone's got their own opinion as to where rates are going, but the bond market is telling us in no uncertain terms that it really does not expect that the growth moving ahead is going to be particularly strong. There's fear permeating this market, and you could see it with how both the yield curve is flattening, as well as how much there's a strong bid on the very long end of that yield curve. And it's also very telling that today other competing duration assets really did not have a bid. So if you look at, you know, high grade debt, high yield debt, those yield spreads are still pretty high, and that stuff was being sold off, as were rate sensitive stocks. So all the growthy stuff, we talked about the Russell 2000 factor, the Russell 2000 growth factor being sold down. Well, one of the reasons for that is that looking at what is likely to happen next year is an environment where we're a later cycle and where allocation preferences change away from long duration assets, that is to say a long duration before they produce cash, to assets that are able to produce cash in the here and now. And so you could see that timeline of risk appetite being pulled forward. And so a lot of that stuff got dumped. I mean, you saw, if you're looking at the market today, the biggest losers out there, DocuSign was down over 40% on the expectation that their growth is going to slow. But even stocks that didn't have their own specific event catalysts that were in that rate sensitive area were getting drawn down significantly. Many of them down over 10% on the day, a lot of them down over 5% on the day. So this is a market that's sending us signals in no uncertain terms that the appetite for where risk is going to be taken is changing. And unless and until the Fed changes their policy outlook and the economy meaningfully slows and inflation concerns are totally behind us, it seems like this rate sensitive stuff is going to be continue to be sold down. So some of these things that were sort of the creme de la creme of the FinTwit elite, these things that doubled, tripled, quadrupled over the last couple of years, they're losing 50, 75, 90% of their value in very rapid succession. And a lot of that COVID premium is being completely taken out because the macro environment has changed. And we are late cycle, and it's unlikely that it's going to revert, that is to say, to an earlier part of the cycle, unless there's a significant economic slowdown and a change in Fed policy, both of which don't seem likely near term. So, be advised, watch institutional flows. You can get a good idea as to where the market's going by paying attention to where the money is being put.
Yeah, follow the money, right?
Yes.
You're definitely in the... it's interesting on the inflation narrative is they've managed to bludgeon oil and gas, right? Well, that's when as in gasoline, but also natural gas. So that's a massive part of what PCE and core, however you want to take inflation. And that's why they use the Fed's favorite indicator is the Dallas PCE. What's interesting, they could have stuck with their transitory theme on that if that's really what they wanted to do. So it's interesting the ride around the reaffirmation of power by Biden, and we know Biden's very much a hawk. He's a strange bird that we saw this shift. So there's all these kind of underplayed political plays going on. It's going to be an interesting shift, and the long bond is your classic rush to safety, right? So, which is what we're talking about, but it also represents long-term growth projection. It's going to be an interesting time, and these moves are very much exaggerated by people that levered themselves up. The 4-to-1 margin. Just think about it. If you own DocuSign, that was a marginable stock, fell 40% in one day. And a lot of these people have been dip buying. So they're longer and longer. So they have to, these things can destroy a stock market.
Yes.
And that's what people forget.
And that's a really important point, because one of the things that really doesn't get enough talk until maybe the last month or two is just how much options are driving price action in this market. And there was a paper put out recently that suggested that options volume is now 50% greater than the volume in the underlying, in those commons. And that's a big shift. And that's something that's been growing over time. But the last 2 years, it's really gotten extreme. And, retail participation, but also the way institutions are participating is shifting more and more towards these options. The sort of derivative has become the asset. The tail is now wagging the dog. And for some of these things, earlier on, like DocuSign or things like NVIDIA or Tesla or Upstart or Asana or Affirm or otherwise, we saw these delta and gamma driven options events where prices were rising rapidly. There was no event catalyst, but if you looked at the flow, you could see that buying activity, unusual amounts that exceeded the open interest for that strike in the next month were really, really unusually high. And usually the strike was just out of the money unless it was one of these gamma attempts, but a lot of the stuff was just, ladder it up from one strike to the next, trying to force market makers to hedge delta, pushing shares higher as they buy shares to neutralize their risk, having written calls. And so this is something that's now reversing. We're now seeing the sort of other side of it. And an example of that was what happened to the S&P on Wednesday when it had that sort of waterfall decline into the close. A lot of that was 0 DTE and 1 DTE and really short-dated put buying that was happening, that was causing the opposite reaction, where market makers had to hedge delta by shorting S&P and size into the close. So, these things, these squeezes driven by options, if you want to call them that, they can go either way. And so one thing that I think
people
we really
forget that.
Yes. And I think if we do get into a bear cycle, it's something people really need to remember, because all the hedge funds and other leverage, funds that are playing with this on the long side, to see them start playing on the short side, or seeing them start playing on the put side, that is to say, that is a very disconcerting development. And for some of the stocks that have nothing but pockets of air below them, they could very easily invert that strategy and make a lot of money pushing them down.
What's interesting, so back in natural gas, this is a phenomenon that's been around for a long time. And most people are unaware of it, the OTC markets, how big they really are. We call them the black pool, I guess is very similar in stocks. But I've seen, and I won't mention his name, but one well-known fund manager in natural gas would often buy 10,000 contracts, right? OTC. So just imagine where that moves. So that's in that. Oh, why to do this? Why to do that? A lot of it's just pure financial. So that's now crept into this. And as far as probably a glaring example, we had Elon Musk sell. I mean, how many billion was it the last 2 weeks? 10, $20 billion, right?
Or even more than that.
So crazy amount of volume. And they kept taking the stock higher because of either no concept of what that actually meant, right? Or just pure gamma. Then eventually, and look what it's done since. Same thing we saw with, I guess it's 2 years ago now, but when Jeff Bezos got a divorce, and then himself and his ex-wife sold billions. I mean, I can't remember. I don't want to throw a number out. I'm not correct, but significant amounts of Amazon stock. And these are real events, and they do it both with an excuse. So it doesn't get the same fire sale mentality of the market. Bezos, we're getting divorced, we got to sell. Musk, I've got to pay my taxes. I'm being a good Samaritan, whatever it is. So it has a different but in reality, they're selling that much stock, making beaucoup money, I might add. I don't think they're too unhappy about it. But the point being, that's real. The stock, and so you can move a market by buying lots of puts, and it goes both ways, and buying lots of calls, well known in GME. And don't kid yourself that the whole narrative is that's a bunch of kids in a room. That's big hedge funds against other hedge funds pushing their position. We saw the same thing in natural gas back in the day with people like Arnold and all these knowing other people's positions, pushing these basis curves right out the way. And that's pretty decadent, really, when you think about it. You want to talk about ethics and all that, but let's not go down that road. But that's such a big part of the market that really runs it. And that people, growth targets. I can name plenty of companies that are way oversold that actually make money as well. And more of the smaller, they just haven't been picked on to go up by an analyst, or they haven't taken the right banker to lunch. Who knows? But there's all these things that are out there that are real, that influence markets. And as one day we will sit down with Hussein, who knows that market backwards when it comes to stocks, and he's seen so many things he could talk about there, or can't talk about. But on a serious note, there's more to, and you see it all come. Unfortunately, the people who need to understand that are the ones that are mocking you as they go up too high. And lo and behold, this time wasn't different. And next time won't be different either. But what I do think is constructive, as far as the long-term part of the stock market, if it holds, they are buying other stocks, selling out of something, buying other stocks, rather than a wholesale dumping, right?
And let me add one thing, Andrew. The problem is, you see how hard these markets sell off. I mean, it took 6 months probably for the market to get there, but it wipes it out in a day or two. So what goes up and doesn't come down usually just as fast. The speed of the sell-offs are usually dramatic. And if you miss days like this, or you get caught into something, it could really take a long time for you to recover.
Right,
yeah.
Right. Up by
That's
the
a good
stairs,
point.
down by the escalators. you know.
I would even go as far as to say up by the stairs, down by the empty elevator shaft. I mean, some of these things are getting cut so fast, so hard. I mean, and I feel bad because honestly, there's a lot of people, you know, that cut their teeth investing, if you want to call it that, in 2020, and the returns were just absurd. I mean, you could throw a dart out there at any stock and pretty much make money on it. And so people got used to the idea, even complacent with the idea of not only abnormal returns, but a lack of risk management. So we've seen retail take on an inordinate amount of leverage. And this is a really dangerous type of scenario. And there's a lot of people getting burned because they're leveraged into some of these really high beta names. So you already are talking about 2, 3, 4 times portfolio leverage. Then you combine that with names that are moving 5, 10, 20, 40% on a day. You can see the margin liquidations in the tape. There was absolute panic out there. Yeah. Oh, yeah. I mean, absolute panic in some of these names.
And this is one day. Just imagine a week like this, a selling like this could put people back 3 years of their portfolio holding. So just be very careful out there.
Well, actually, it's almost like, look, what I saw today and really this week on certain names. It used to take a year to do that. Like if we look at the 2000s, 2008, even the recent one, COVID, it's so powerful now because there's no buyers, there's no bid. It's bidless. You know, so the only buyers are people that are short taking profit. That's the other thing. You ban short selling, it gets even worse.
Yeah, exactly. That's something that most people don't understand. I think that's really important to actually take a moment to discuss that short sellers, by and large, you know, and I'm not talking about people putting out reports or trying to push prices around. I'm talking about short sellers you never even know they exist. All they're doing is adding liquidity. Right. And that makes it a better market to trade for everyone. So, you know, there's this sort of like popular meme, oh, short sellers are evil. Oh, they're the reason my stocks are going down. No. The reality is that people selling your stocks and longs, you know, you can get mad at longs too because they're exiting. They're driving your share price down. What happens when a short exits? They buy. They actually have to drive the price up potentially if they're going against the tape. And that's why, you know, people also talk about these short covering rallies. So at the end of the day, shorts play an important part in the mechanics of the market. And they're just another party that is adding their opinion to the order flow. There's nothing wrong with shorts as long as they're playing fair. Now, obviously, that's not to say that the people that are writing reports and benefiting from them are fitting into that category. I think that's a little different. There's some moral vagary there.
Yeah,
but in terms of just pure... and I'm not a fan of that stuff, but if you just talk about the pure play shorts, the ones that aren't even talking about their positions, you don't even know they exist, nothing wrong with that. Nothing wrong with that at all.
In fact, it's more wrong with how about why are you paying $300 over for a stock that doesn't make money and it's got no future and has to raise money?
Right.
But it's, it's a guy that wants to sell it. It's fault.
And some of these names might never recover. It's just like some of those stay-at-home stocks that are not just getting billionaires. The reason that Microsoft and Apple and all them get a lot of the buying, because those stocks people believe they'll be around 4 years from now. They
make money. They pay a dividend.
They've been around for a long time. But some of these new high flyers, we never might ever see these prices again, especially if they lose money. They're going to be diluting more. There's going to be, you know, there goes the story, if you know what I'm saying.
Yeah.
And that's...
But it's not.
It is.
On some
it's... But what you just described, Mahdavi, is kind of exactly the reason that quality is favored and rate sensitive has to be sold. Because the reason that some of these stocks are rate sensitive is because they have debt, they have to raise more debt, and the cost of that debt is what's being discounted by higher rates as we move forward. So, you know, if these companies don't make money or they have to use a lot of leverage to make any money, you know, their whole business model is going to have to be adjusted and really de-risked. As we move forward into 2022,
and a lot more stock.
Exactly. And so, you know, for investors and traders out there that are listening, remember what we have experienced is totally unusual. The last 2-year period in the markets, there's really never been a time quite like this. And then if you want to go further back, you talk about post-Great Financial Crisis from March 2009, you know, until 2019. That was also a very extraordinary period. And while there was more volatility there, it was still unusual to see such a liquidity-driven market. So we are in a different paradigm, but that doesn't mean that this time is different. What it means is that the inherent risks, the fragility of the market is more significant than it has been in prior cycles. For one, because the beginning of this particular credit cycle happened with the most abrupt you can't even call it a bear market. You call it an extended correction. What happened in March and April of 2020, that didn't really reset the cycle. And then on top of that, you had central banks around the world putting in about 12, 14 trillion dollars, and they front loaded that policy. Now, every other cycle that I've studied in modern history, the policy response has been one of, cutting rates, and then recently adding QE after rates had been cut. And this was a graduated process. And that's why the cycle started slowly and also ended more slowly. This time was different. All that policy was front loaded in, and so the cycle started like from 0 to 60 within days. And that's totally unusual, but that also explains why the velocity of liquidity entering and now beginning to exit the market is so intense.
And one thing we got to keep in mind, the bear market, I really think started months ago, because they've been selling all these other stocks you see are down 20, 30%, but they've just been buying the Microsofts and the Apples and everything. They're keeping the indexes up. And now it just, the indexes are getting hit. This is when the full blunt is coming. But you can really look at everything else besides the big five, what you call it, big six. And they've been selling everything. A lot of those stocks are down 20, 30% already. So the bear market's been on their way for some time, I believe. But we haven't seen it on the big indexes.
And plus they manipulate the index. They take out stocks and put in stocks, So they've been doing that. I mean, like, people go, oh, that stock's down so much. It's like, well, why did it go up so much? And that's been the trouble,
Yeah. Yeah, that's a good point. And two things I want to touch on that you guys both kind of talked about a little bit, but I think we should talk about in greater detail. The first is, how big Microsoft and Apple and Google and Amazon and Facebook are as a part of the S&P and the Nasdaq. I believe that they are about 24, 25% of the S&P and about 40% of the Nasdaq. Apple itself, just AAPL, is 11% of the Nasdaq. So then you got to factor for how many passive flows go directly into these companies, right? When you're buying the SPY, you're buying the QQQ, or institutions are allocating into the indices, how many of those passive flows directly benefit these stocks? That's one reason they see such consistent upward price revisions. And another one is the just inordinate amount of share buybacks. I think with the exception of Amazon, all of those companies have been engaging in significant share buybacks. And I want to say for Apple, since 2014, they've decreased their float over 40%. So, and through buybacks. So there's a lot of reasons that these stocks are outperforming that aren't necessarily healthy or optimal, which is another reason to be a little bit concerned when upside breadth participation is so narrow. And it has been for several times during this cycle. And also, what Mahdavi was talking about there with regards to the kind of what's going on underneath the surface, we've had what is extraordinary for any other market in history. Whereas, thematic rotation or sort of the preference of what kind of sector that you're buying and why, we have not seen that kind of turbulence, really. I mean, we saw some hints of it after the great financial crisis where there was a lot of confusion about where we were in the credit cycle, but not with this velocity and not with this kind of violence. And now we have kind of like every other week or month, the market is trying to figure out, are we growth? Are we value? Are we late cycle? Are we mid cycle? And that causes these rolling corrections underneath the surface that hints at the idea that, yes, indeed, parts of this market have been in a rolling bear market for much of this year, really from the back half of February on.
One thing I decided to finish up with, which I find mindless, as we see Square hit lows here, is the childish behaviour from some of these corporate leaders. People like to criticise the political leaders, which isn't hard when you got Trump and Biden, I guess, in all jokes aside. But how about, firstly, we had the WeWork guy from a few years ago, and he's back out and we're in trouble. I think we talked about it this morning. But you've got Facebook arrogantly just simply changing the name to Meta, thinking it's going to cover everything up, which it effectively did to a lot of people because they just don't see greed. Then you have the bloke jump from Twitter and get into Square and change the name there, block, without any mindset of what this may do to the actual underlying sensitivity to the stock, etc., and then how that affects in the market. So you've got that from two big, that's leaders, well, not the WeWork guy, but that's two massive companies out there, right? And there's that mindset of, it's not reality. There's no, I guess, responsibility, conservatism, and I don't mean political conservative. I mean, hey, I got responsibility here. Let's be smart. Let's ease people into it. It's almost childish. This is my plaything. Yet people are putting so much money into that, right? Dorsey's the guy I was trying to think of.